Hi, this is Greg. On this channel we talk about markets and investment, and on this episode we're going to be talking about a recent interview with Stanley Druckenmiller, wherein he talked about the radical policies of the Fed and the government's fiscal policies, which are completely out of step with the economy. Now, I found this interview particularly interesting because not only is Stanley Druckenmiller considered one of the best investors in the world, he's truly a master of the universe, having founded the quantum funds with George Soros and then having a very successful solo career in running a large hedge fund. He is truly considered one of the best investors and one of the smartest guys on the planet. I always pay attention to his views because they're usually right and extremely insightful. Now, if you've been watching this channel, and even if you haven't, I have been talking for months about how I thought the Fed was out of step with its excessive money printing and facilitating all this enormous fiscal stimulus that the government has been injecting into the economy. I predicted many months ago that the economy was going to overheat and that we were going to get an extreme increase in inflation, which this past week has completely been verified. So before we get started, I just want to say, if you get value out of this, please like and subscribe and hit the bell so you get notified for future presentations, because we'd love to have you on board for similar content that I put out every week on this channel. Okay, so this week Stanley Druckenmiller sat down with CNBC and went through his basic thesis about where we are with Fed action and all the fiscal stimulus that's being injected into the economy, and discussed how completely out of step he believes these policies are with the underlying economic realities. At a time when the vaccine's coming in and many people have been vaccinated, just today the CDC dropped the requirement of vaccinated people to wear masks indoors or outdoors. And so what we're experiencing now is really a V-shaped recovery, but yet the Fed continues its policies of buying $120 billion a month of securities, injecting enormous amounts of money into the system through money printing, essentially. And meanwhile, the government continues to shovel money into the system, which is basically being monetized by the Fed. So it's like this kind of evil Ponzi scheme almost, whereby the money supply is rapidly increased, and the natural trend, of course, is to trash the dollar. Now, this is all well and good. I mean, you know, in the short term, we're all happy, right? Because our stocks are going up because there's so much money in the system. The money's got to go somewhere, so it's going into stocks. And in the short term, you know, everybody's happy. The punch bowl is out and everybody's partying, and it's great, right? But at some point, there is going to be a day of reckoning, and that is what Stanley Druckenmiller is talking about. And let me tell you, if this interview doesn't make your bowels watery, nothing will. So without further ado, let's go to the interview. Let's look at the interview, and then I will analyze the interview afterwards and go through my conclusion and the way I'm viewing what he's saying. Now look, Stanley's, he's a genius, right? His IQ is probably 200 or something like that. But, you know, he's not the most exciting guy to listen to. He's a little hard to listen to. But what I'm asking you to do, just hang in there and listen to him and try to understand what he's saying, and then I will come in afterwards and analyze the interview along with you. Okay? So here it is.
But first, Stan Druckenmiller, CEO of Duquesne Family Office. Stan just wrote a new op-ed in the Wall Street Journal. In his words, the Fed playing with fire, clinging to an emergency policy after the emergency has passed. Chairman Powell courting asset bubbles. And Stan, in the past, you have pointed out that the Fed has stayed a little bit too long, I think after the financial crisis, with emergency accommodation. But you seem to have taken your criticism up to a new level, to the point of, if you combine fiscal policy that we're seeing with the monetary policy, it's the scariest combination in the post-World War II period, in your view?
Certainly the most radical policy by a long shot that I've ever seen relative to the economic circumstances. Let's not forget that Ben Bernanke at the peak was doing $85 billion a month. We are now back to normalization on GDP. We're above trend on retail sales. Funny, last year at the Economics Club, around this time, I said that a V recovery was a fantasy. I couldn't have been more wrong, but this is all about risk reward. I understand why the Fed and Congress did what they did at the time. I think it was the right decision on a risk reward basis. But when the facts change, you have to change. And the facts have changed dramatically since then. And yes, I can't find any period in history where monetary and fiscal policy were this out of step with the economic circumstances. Not one.
Stan, you talk about how quickly the job market has come back. And you pointed out retail sales, a lot of other things that are almost pre-pandemic levels. And in normal situations, you might think that the Fed would be talking about an interest rate hike right now. And you point out it's 32 months. The other statistic that I saw you point out was, and I don't have it right here, but the amount of asset purchases that the Fed has orchestrated just in a very brief period of time, it eclipses what we did through the whole financial crisis for the 7-8 years after the financial crisis. What is that number?
In 6 weeks last spring, we did more QE, more purchase of treasuries than we did the entire time, the 9-year period from 2009 to 2018. Frankly, Joe, I don't have a problem with that. We were in a black hole. No one knew where we were headed. What I have a problem with is the Fed is expected to do $2.5 trillion of QE after vaccine confirmation and after retail sales reach trend and we're above trend. So the black hole didn't occur. That's wonderful. We're all happy, but we're still acting like we're in a black hole, and in fact, the economy accelerating. Could your producers bring up the chart of retail sales? Is that possible?
Yep, I think we've got them already that we can bring up. There it is.
That's the third chart.
There it is. I think it's up now. U.S. nominal retail sales.
Okay, so if you look at this is a chart of retail sales the last 20 years. And as you can see, they grow about 3% a year. And after the great financial crisis, it took about 6 years to get back to trend. If you look at the current recession, it's like nothing we've ever seen. A sharper decline, but then within 6 months, you were back to trend level. And you see check one, that's the first stimulus package. That's the one I have no problem with. I think it was the right risk reward, which was right at the bottom. But look at check two and check three when they're coming. Not only are we back to trend, we're now 15% above trend. To put that in perspective, retail sales grow at about 3% a year. So we are 5 years worth of demand above trends. There's some pull forward here away from travel, but it's not 15%. So when you look at this chart, and then you look at the Fed policy and all the stimulus and them talking about the hole we're in, I just think it's totally inappropriate.
Let's talk about the dollar. And 85% of the transactions are still done in the dollar. You pointed out in a recent speech that you think we've crossed the Rubicon. Are you comfortable saying what you said there, that for the first time in your career, you think we lose reserve status at some point?
I'm comfortable with it. That's my central case. As you know, Joe, I can change my mind. But yeah, you said that to some extent, the Fed is enabling the fiscal transfers. It's not to some extent. They couldn't be doing this without the Fed. The Fed is monetizing their activity. I mentioned all the QE after vaccine confirmation and retail sales. We've had 850 billion of direct transfers. 575 billion of them came after retail sales were above trend. 575 of the 850 billion. I'm old enough to remember the bond market vigilantes. I used to be one of them. Without the Fed buying, I don't know what the exact number is. I think it's 60% of all the debt issued. The bond markets would be totally rejecting this. So they are enabling this massive expansion in fiscal policy. And the problem is, if you end up getting inflation, and frankly, even if you don't, the debt is going to be so big. You remember I did my entitlement talks 8 or 9 years ago. That's all happened except for one thing, the interest rate level. So we're right now in the crux of when the baby boomers accelerate in terms of getting Medicare, Medicaid, Social Security, that stuff. Right as we're doing that, we just put 6 trillion of new debt on. Again, all enabled by the Fed. These guys could not be doing it. Bond rates would go to a prohibitive level. So my issue here is, in the future, as we go forward, if you look at, do you have chart 5 up there?
Let's get it. I think we can do it. Which one?
It's federal spending, Social Security and major healthcare programs. Federal spending is percent of GDP. This is the CBO. This is not me. Okay, and they're saying if 10 years go to 4.9%, which is their normalized projection, the interest expense alone will be close to 30% of GDP every year. That's basically what we just spent on the COVID emergency in the last year. There is no way we can afford to have 30% of all government outlays be toward interest expense. So what will happen is the Fed will have to monetize that. When they monetize it, I believe it'll have horrible implications for the dollar. And that's why I said in that speech, yes, that I think it's more likely than not within 15 years we lose reserve currency status. Can we go to the chart on the dollar specifically? Because I think this is really important. Last spring, in the midst of an equity market meltdown, and I've been trading for 40 years and I've never seen anything like this, right in the middle of an equity market meltdown, the bond market went down 18 points one day. And everybody thought it was macro traders like me and others that were rejecting the implications of the CARES Act. The Fed did a deep dive, and by hindsight, foreigners sold $1 trillion, of treasuries overnight as we were proposing the CARES Act. They've continued to sell treasuries ever since then. Why is that important? Because for 20 years, treasuries have been the go-to asset of foreigners to hedge global portfolios with. In every case, whenever you had a problem in the equity market or in the world economy, they fled to treasuries and they fled to the dollar. Last spring, that was violated. So since then, they've continued to sell treasuries. So what we've gone from is, for 20 years, an average flow of 500 billion a year into treasuries from an outflow out of treasuries. So when you have a $700 billion current account deficit, our estimate for the year, you need capital to flow in to offset that. If you just erase 500 billion inflow and turn it into an outflow, you see the pressure will put on the dollar. A reasonable person might ask, well, if that's true, why did the dollar not go down from March to July? Very simple. Who was the biggest beneficiary of COVID? Obviously, the massive digital transformation companies, Google, Microsoft, not so massive, but Zoom, those kind of names. What country dominated in terms of those names? The United States of America. So the $500 billion outflow out of bonds was offset by a massive inflow from world central banks, from sovereign wealth funds into our equity market. By July, that had become pretty much in the market. the relative prices had gone up, and frankly, the vaccine profile was starting to look better. So that is when the dollar peaked, as that offset started to diminish. And as you know, Joe, the vaccine tends to cause a rotation out of growth stocks into value stocks. Our big advantage over here are the growth stocks. So that's why I think the pressure on the dollar is going to continue.
I think I'm going to need a diaper after that. But anyway, all kidding aside, let's talk about, I think there are 5 major points that I got out of this interview. And let me go through them now, and hopefully it'll clarify and bring into perfect synchrony what he's talking about here. Number 1 point is that what the Fed and the government has been doing are the most radical policies by a long shot that the government and the Fed have ever collectively or independently executed in the history of the United States. And the point that he makes very clearly is that all of this is happening, or a lot of this has been happening, certainly the $1.9 trillion that was just passed by the Biden administration, all this has been happening when the retail sales trend, as he showed by that chart, is already at or above, where it is now, it's significantly above trend. Okay, a second point is that the Fed policies and the government policies that we're seeing here have, as he says, passed the Rubicon. And what he means by that is there has been so much debt issued, and the Fed has monetized this debt that has been issued, these trillions and trillions and trillions of dollars, $6 trillion since the pandemic started. This money was monetized by the Fed, and what that means is the Fed basically bought the bonds. The Fed basically printed money and bought the majority of those bonds. His point is, if there was true price discovery in the market, which right now, of course, there isn't, the interest rates would have been too high for all that debt, and the government basically wouldn't have been able to issue the debt at all. So it would have been shut down by the bond vigilantes, or the real bond investors, and not the Fed. Now, when he says pass the Rubicon, what he means is that the situation is being set up with this, as he considers, reckless policy to eventually debase the dollar to the point where we will lose the dollar's status as the world's reserve currency. Now, just a quick word, in case you don't know what reserve currency is. The dollar is the world's reserve currency because 85% of all transactions in the world, all major transactions, are carried out through dollars. Anytime you go to the world market, for example, and you want to buy petroleum, you want to buy oil or gas, or many commodities in the world that are necessary for a country's survival and necessary for a country to even operate, they have to have dollars. And those dollars take the form of reserves. So each country, like China, for example, has to hold an enormous amount of dollars in reserve so it can affect transactions on the world market. So as a result, there's almost an infinite demand for dollars in the world. And that is why our government can irresponsibly and recklessly print so much money and do this QE ad infinitum without any real consequences, because foreign governments require dollars, and so they almost have to buy them. The other point he makes is that 60% of all of the Treasury securities today are being purchased by the Fed. He cited that in the last go-around, $850 billion of securities were purchased, with $575 billion purchased after retail sales were above the normal trend. What this does is it not only completely enables reckless fiscal policies, but it also is increasing demand way above trend, and that, of course, on a supply level, on a demand level, is going to cause inflation. And that's what we're seeing right now, and that's the market was actually spooked this past week regarding inflation. The fourth point he makes, which is really scary, is that if you were to take that $6 trillion worth of debt and add it to the rest of the debt we have outstanding and subject that debt to a 4.9% assumption, which is what the government uses in its projections, just the interest on the debt would equal 30% of the entire economy of GDP. Okay? And if that happens, the government basically will have to cut back in other services and will be really up shit's creek. So the fifth point is that if we get to the point where just servicing the debt is 30% of GDP, the Fed will have to monetize all that. I mean, it's the only way it could be paid, and once it does that, it will completely crush the dollar, and he is predicting that within 15 years, we could lose our status as the world's reserve currency. Now, this point is far more than theoretical. In fact, when the CARES Act was first announced, what we saw was a tremendous amount of foreign governments selling treasuries, and strangely enough, those billions and billions of dollars that were sold, that money basically ended up going into the stock market. So we didn't really notice it, and of course, ironically, the companies that benefited were the large FANG stocks, the tech stocks, Google, Facebook, etc., and also the stay-at-home plays that resulted from the pandemic. Okay, so my takeaway from all this is that when a guy of the stature of Stanley Druckenmiller speaks like this, I tend to listen, and I think that you should too. And while we're happy in the short term that our stocks are going up, and we hope that that trend continues, at some point there's going to be a day of reckoning, and it's good as an investor to be aware of the policies of the government and the Fed, which at this point in time appear to be excessive and reckless, using emergency measures way beyond the point of emergency, and being reluctant to begin to taper and to raise interest rates. Okay, so if you got value out of this presentation, please hit the like button, smash the like button actually. Please subscribe because I'd love to have you on board, and also smash that bell so you get notified when I come out with new videos, which I usually try to put out at least 2 a week. And we talk about the markets and investment, and I try and give you my best investing ideas, which we've done all along for about a year now. And I'm looking forward to you subscribing so you can be on board for future presentations, which will be coming your way very soon.